Hey everyone, welcome to the KE Report and another daily editorial, this time focusing pretty much exclusively on precious metals, equities, and even the precious metals sector. So we're chatting with Dave Erfle, founder and editor of the Junior Miner Junky. Now, Dave, we were talking off mic, and quite frankly, look, there's a lot of good stories, a lot of good companies in especially the gold space, but even the silver space to point to in terms of stocks that are starting at least a shorter term chart from lower left and moving to upper right. A lot of gains have been made in not just now a handful of stocks. I find that breadth has widened out to more stocks doing well and generally just having better returns for investors. That always brings up the question, is it time to adjust some holdings, maybe trim some holdings and move into some of the lagging stocks, ones that you still think have good assets? It's clearly not time to go into all the exploration plays, but how about all these companies that do have defined resources, that have been around for a little while, that are moving down that de-risking path, but their share price hasn't moved? Is it time to start buying those, Dave?
Yeah, I think so. I mean, trimming, yes, but as far as selling out completely, no. You want to maintain core positions here because, I mean, we haven't even begun. Well, maybe we've begun to see some retail come into the sector, but really not much. If you take a look at the volumes in GDX, GDXJ, and the TSX Venture, we're not seeing outstanding volume being accompanied by this move. We're seeing GDX and GDXJ getting to those October highs. They haven't reached there yet, but they're getting really close. But yes, I mean, I think you are starting to see some internally, as far as sector speculators are concerned, they're probably taking some of their outsized gains in the miners and royalty companies and mid tiers and rotating them into some of these laggards that have a lot of ounces in the ground but have created bases that haven't really started to move much. And the last few weeks they have started to move. I've seen some really strong moves in a lot of these optionality plays with good volume, especially if the move is related to positive permitting news. I mean, I remember last week we talked about Skeena Resources being one of my biggest gainers this year and last year. And almost as soon as it came out of my mouth, the BC government came out with an initiative to fast track 18 projects, and SK Creek is one of those projects as far as permitting is concerned. And the stock just had a huge move. And I saw a couple of other stocks that aren't associated with that initiative have strong moves too, with big volume, because they're also looking for other projects to fast track. So smart money is looking out for a lot of these late stage companies that are at or getting close to being in the permitting process that's going to benefit from this initiative in BC. And I wouldn't be surprised to see other provinces, especially Ontario and Quebec, eventually do the same thing.
Yeah, Dave, you said it. Boy, we really need to see the mining sector work with government and in a synergistic way where we improve these timelines. They're so long and so onerous that a lot of investors aren't willing to make it through what they call the valley of death on the Lassonde curve, the orphan phase, where there's all the de-risking and economic studies and permitting and metallurgical work. And those are the projects that are actually going to get built. But the timelines are so long to actually get them permitted that people lose interest or the majors don't acquire them. If we're going to see more M&A, if we're going to see more mines built, we need to shrink those timelines. But let's zero in on these optionality plays because it's not a one size fits all category. There's some optionality plays that'll probably never get built. They've been on the rack for multiple cycles. There's some that actually have legit projects, good ounces in the ground, good economics, but maybe they have a permitting snafu. And there's some that have all their ducks in a row. How do you filter through the noise in the space? Because there are optionality plays that will eventually shoot from behind and outperform even the most quality stocks and producers. How do you filter out for quality over quantity?
Yeah, you just can't look at a company and say, wow, look at all the ounces they got in the ground. I'm going to buy this. There's a lot of particulars you got to focus in on. You got to look at share structure. You got to look at how many warrants they have out. You got to look at how much cash they have in the bank. You got to look at how far out is their project going to be shovel ready. Is it in a jurisdiction that government is looking to fast track permits? There's all these things you got to look at. Is the management team fully aligned with shareholders? Have they got a large chunk of their net wealth in the company? Do they continue to participate in financings? But as far as cash is concerned, that's a big one. I mean, if the market looks at a company and they like what they see, but they only see about 6 to 8 months of cash in the bank, they know the company's probably going to have to raise money. They're not going to touch it yet. So there's a lot of these particulars that you have to look at before you jump into these optionality plays.
What about just on the resource base or even economics around these projects? Because in all fairness, if we do get a bit of a better market, then some of these cash issues, at least the short-term issues, can be solved because money frees up. But when you're looking at these resources, I've made the argument that we just have too many defined resources out there. So it dilutes the whole pool of a million ounces. A million ounces just clearly isn't worth as much as it was 10, 15 years ago. But there are quality 1 million ounce deposits out there. And now, because so many projects have been around for so long, a lot of these projects have economics around them. And at these current prices, it seems like damn near every project should be very economic. So what do you look for within these resources? Is it all about grade? Is it all about any other considerations that you might have?
Sure. It's also about when was that economic study done? There's a lot of these projects that have been sitting around for a while. These studies were done 2, 3 years ago, and inflation has gone up a lot since then. So these projects the capex is probably 20 to 30% higher. You got to factor that in. And as far as, why you got to look at why is the company lagging on the project? Is it permitting? Is it strategic funding? They haven't got any strategic funding. Are they doing just a little? They're just doing little raises here and there just to basically keep the lights on and keep the company going while they attract a strategic partner. Is the project strong enough to attract a strategic partner? That's a big one. I mean, how are they not only going to get the finance to keep going for this year or next year, but how are they going to attract a finance package to build the thing? That's what you got to look at. And of course, you can get out ahead of it too. You could put your major and mid-tier mining hat on and look around at these companies and say, oh, look at this project. This is a project that a strategic partner would basically be really wise to get a hold of this one, because look at the numbers on this thing and look at the blue sky potential. Look where it is. There's still several companies out there that I think that maybe are close to getting a strategic partner, or they've got a project strong enough to attract one.
Well, let's dive into strategic partnerships, because there's a lot of ways to do it. Some companies have a joint venture agreement where it ends up being a 30-70 or even up to a 50-50. Sometimes the strategic partner comes in at the equity level and maybe does a 9.9 or a 19.9% equity hold, but they may or may not re-up that. Some companies have an earn-in agreement where over time they're going to come in at the project level. So you're either diluting down at the equity level or you're diluting down at the project level. And then obviously other companies have royalties in the mix. What kind of strategic partners do you like to see? What ones do you like to avoid?
Yeah, I mean that's a great point. That's another thing. You don't want to see a company give away too much of the project either. As far as strategics are concerned, I don't like to see any more than 9.9% from any one strategic partner. The lower, the better. The market just wants to see that access to capital. So yeah, I mean, you want to see strategic partners from a power company or a mid-tier or a major, or maybe it's a high net worth billionaire, serially successful financier who's made a lot of people a lot of money in past projects. There's several of those out there right now where you can even get into them at less than their average cost if you do some digging. That's how cheap these things still are.
So, Dave, back to some of the areas that you said could improve in terms of permitting. You pointed to Ontario, you pointed to Quebec. Does that mean we focus on some of the best known areas in those provinces, like the Abitibi, like Red Lake?
Well, yeah, I mean, if you're like me and you think that it looks like this is what's going to happen, that these other provinces are going to jump on board and start fast tracking things, yes, I mean, you want to look in serially successful mining camps that have produced a lot of gold, and there's a couple of them in Ontario and in Quebec, and there's a lot of projects there that need to have their project fast tracked.
In your opinion, what's holding back more M&A in the space? I mean, we can say that last year was a bang-up year for M&A, and it was. There was a lot of mergers and acquisitions, but we're not seeing a ton of it so far this year. Gold prices are ripping higher. Economics on projects are looking better. Whether you're a small producer or a large developer, these are attractive assets. And Newmont was divesting a lot of projects. People thought that was an overhang. They're pretty much done now. What's holding back the M&A?
Well, I think, these gold prices, I don't think that these companies are convinced that the gold price is going to continue higher. They want to make sure that they don't make the same mistakes of the past. So, during the last cycle, the gold price ran up, from what, 250 to like 1900 in 10 years. And they waited till the end of that move to start really doing a lot of this M&A. And they basically added lower margin projects, bulk tonnage projects that needed higher gold prices. That's not the case right now. But as far as M&A is concerned, we are seeing a lot of it, and we need to see a lot more within the junior space. A lot of these single asset companies should probably merge with other single asset companies, or maybe get bought out by multi-asset companies. But as far as the majors are concerned, we are seeing a lot of M&A, and I wouldn't be surprised to see a lot more as the gold price remains up here above $2,800 an ounce.
What about all these majors with, quite frankly, their pipeline of projects? These majors aren't necessarily running short on projects. They're just running short on near-term growth, I feel like, in terms of needing to spend a lot of money to move projects into production and, quite frankly, even grow their projects. Do you see any opportunities in companies or assets that are already being mined as takeover targets, or those being more opportunities for investors?
Yes, I do. I mean, I do see that, and there's a lot of them right now that are still undervalued in relation to peers, and a mid tier especially that's looking to grow. It's a lot easier to grow by adding another asset than going out and building one yourself. So I do see that happening.
Dave, we haven't talked a lot about silver here, but the silver price has done okay. It's in the low 30s again, which is not a bad price if you're a producer, not a bad price if you're a developer. Do you think that we're going to finally get the silver catch-up trade just from gold continuing to blast higher, or is silver marching to the beat of its own drum?
I mean, I do. I mean, last year was a really strong year for the gold price. It was up over 27%. And until the end of the year, it was for the silver price. Silver was outperforming gold until the last few months of the year. So, I mean, if you take a look at the applications for silver, the demand for silver, the silver's been in a structural deficit for the past 4 years. It's more of an industrial metal now than it was back when it peaked at $50 in 2011. I think it was 40-60 as far as industrial investment demand, and now it's the other way around. I think it's 40% investment and 60% industrial, but industrial applications continue to rise, and the solar industry is just booming, and it's going to require a lot more silver. So, the impetus is there for the silver price to start catching up to the gold price, but the gold silver ratio is still hanging around its high around 80, 89, 90. It needs to get down below 80, and especially below 75 to 1 to really start getting some juice into a lot of these silver stocks. Several of them, a couple of them that I own, are outperforming and they're doing really well, but there's still a lot of them that are still on the floor, and they need higher silver prices to get going. Especially, they need that gold silver ratio to get lower.
Dave, what does this environment remind you of where, quite frankly, it seems like most resource investors have almost exclusively shifted their focus to gold and gold stocks? Yes, silver is doing okay, but again, people are more so, I think, invested in the gold stocks and gold specifically. So many people say they're just simply playing the gold price through gold ETFs. Have you seen this in the past?
Well, crypto has zapped so much, interest out of this sector. I mean, most of the speculative capital has gone into the crypto sector, and what hasn't gone into crypto, it's gone into AI. It's gone into both, really. So, I mean, that's what we've been having to deal with for the past decade or so. So, as far as what this market reminds me of. It kind of reminds me of when I first got into this sector over 20 years ago. I was looking for an alternative sector after the dot-com bubble had burst. And I'm not calling a top in the AI sector or crypto sector. It's impossible to call a top, but they both look like they are topping. And once we start to see, some rotation out of there, our sector is sitting here massively undervalued, just waiting for speculative capital. And all it takes is just a little bit of that capital to come into this sector, and it's going to take off. I mean, I got into this sector late in 2003, and I still made life-changing gains afterwards. So now this time I'm 20 years smarter. I know the sector a lot better, and I'm a lot earlier. So I feel really good about the future as far as the junior sector is concerned here in 2025.
Hey, enough said. That junior sector is still waiting for that kind of rising tide to lift all boats. But also, one thing I would caution is when you do start seeing everything moving higher, just be aware that it doesn't last forever. I know that just a little bit of money can move this sector, but history has shown us that when the smallest of the micro caps run, it does sometimes signify more the later stage of this cycle, where right now it's still a lot of the producers and stronger development companies that just continue to outperform. Dave, thanks again for your time. Again, Dave Erfle, founder and editor of the Junior Miner Junky. Click the link in the show notes to learn more about Dave's newsletter. Thanks for your time today, Dave.
Thank you, guys. Always nice talking to you.